Good morning and welcome to the latest iteration of Nedgroup Investments Insights. My name's Robin Johnson, and in this edition today we have Simon Kendall from Prudential Investment Managers. They're our Bob partner, our best of breed partner, and the portfolio manager for Nedgroup Investments Mining and Resources Fund. Thank you very much for joining us today, Simon.
Yeah, well, thanks for having me, Rob, in I think a fairly unprecedented time. That word might be used a few times in this conversation.
Yeah, absolutely. And if we look back, I mean, 2019 was a tremendous year for the resources sector, producing market-leading return of 28% relative to the the market-leading return of 28%, with our fund posting an incredible 40% return for the year. Many people listening will know that was driven by the companies linked to the platinum group metals, or PGMs, something that we'll discuss a bit more later, with Impala Platinum up 300% and Northern up 185, and others in a similar extent. As we entered the next decade, though, 2020 has thrown us on a bit of a roller coaster within the resources sector, and now we're starting to talk about how we navigate such a turbulent environment. So let's kick off there, Simon, and if you could just describe how you and in your role, how you think about the resources sector as a whole, and then maybe we can get into some of the subsectors down the line.
Yes, sure. Thanks, Rob. I mean, basically, so certainly the South African resource sector is a very concentrated sector. I think, especially considering that we don't invest in, or we only invest in JSE listed resource stocks. So we really have four categories that we look at, and we try to balance the risks and the opportunities across those four subsectors, without making big macro forecasts and without specifically forecasting commodity prices. We find that tends to be a mistake. If you forecast a $2,000 gold price and then the equities look good, you tend to make mistakes. So basically, we look for opportunities across the first subsector is non-mining resources. This is normally quite a large segment within the portfolio, but it has shrunk significantly, and oil fits within that category. So currently 6% of the fund is made up of non-mining resources. That would be Sasol and then the paper companies predominantly. The second category is the platinum group metal companies. As Rob said, those have done very well over the past year, and currently that's about 31% of the fund. We started the year in a very strong position, but weakness in the global auto industry has slammed the brakes on autocat demand, which the platinum group metals go into. So that segment has slowed on the back of the virus. The third segment, or the third subsector, is the general miners, and these include the large dual-listed diversified miners. This segment makes up 37% of the fund currently, and within that subsector, one differentiates between the miners that have iron ore exposure and then the non-iron ore miners, and that's on the basis that iron ore has done, I think, remarkably well over the last few years, and even into this current environment. But most of our general miners have iron ore exposure. It's only really Glencore and South 32 that don't. And then just the fourth subsector that we look at is gold. That makes up 24% of the fund currently, and that has grown materially over the last year as well. And those stocks, along with the PGM stocks, have done very well. The commodity price itself has held up well. It obviously offers benefits as a safe haven asset, and that's broader than just resources. Within a balanced fund, gold is an uncorrelated asset. The equities themselves have been a lot more volatile. They haven't performed as well as gold bullion, but they have outperformed the rest of the resource sector and the rest of the equity market in general. So those are the four broad asset classes that we look at, and how we try to balance our positioning in the fund.
Thank you. And I know you mentioned there that take decisions or views without forecasting macro, but there must be some key macro factors both locally and globally that you monitor or that might have an impact on those subsectors that you mentioned.
Yes, absolutely. We certainly make a lot of effort to understand the current macro environment. So what is defining commodity prices and our company fundamentals. And we also look to take a view of which direction we think things are going to go, and specifically relative to what is discounted. So in as much as if I bring it down to commodity price, we will look as to whether the environment is likely to support commodity prices or a specific commodity price to the upside or the downside, and specifically relative to what is being discounted into share prices. But within commodities themselves, we do a lot of work on supply and demand, so to understand whether markets are going into surpluses or deficits, which will inform our view of upside or downside as to commodity prices. And we also do a lot of work on cost curve. So basically, the fundamental anchor to commodity prices is the cost of production and the marginal cost of production. So that's basically at what point what price the 90th percentile company on the cost curve needs to maintain a break-even price. So we do look at macro, but we don't try to explicitly forecast outcomes.
So in an environment where there's a lot of conversation around global growth slowing, and in particular China, or the impact of China on that, and now recent numbers expecting that to halve from the previous 5.5% to 6% to the mid 2s. Is that something that, how will that positively and negatively affect some of the underlying commodities? Yes,
and China is the most important country from a commodity demand perspective. Many of the commodities, 50% of seaborne demand goes into China. So China has been growing very fast off a low base. And it also doesn't produce many of its own mined commodities. So something like iron ore, it's well over 50% of iron ore goes into China. And that slowing has been coming for a long time. So it peaked well up in the double digits a decade ago and has been slowing and was expected to slow. And the Chinese economy has been rebalancing. But I think in previous times of crisis, both in 2008 and then to a certain extent in 2015 and 16, the Chinese economy was stronger and they were able to stimulate, but there was also supply response that was coming out of the miners from capital that they had been spending. That capital expenditure across most of the mining sector has really come to an end. In fact, it peaked back in 2011. So I think the environment we find ourselves in now is an environment of weaker demand, and we're not looking for demand to really be the driver of our equities, of our resource equities, post this recovery. It's really the supply discipline and the ability to keep markets tight. And frankly, if there is upside surprises on supply, on demand, the companies find themselves struggling to respond. And we saw that in iron ore last year when Vale had its slimestone disaster. The industry wasn't able to respond and the price went up. And then later last year when the demand for PGM started to rise and those prices really spiked, there wasn't the ability of the miners to actually respond to those higher prices. So I think I am positive on the outlook for the miners on a medium-term view, but I think it's very much coming from the supply side rather than the demand side.
Okay, thank you. So let's maybe dig into some of the subsectors now, and if we can kick off with oil. There's obviously been a lot of developments in the oil price in 2020, and then so can we start with your comments on that, with the oil price war between Saudis and Russia? Could that have been predicted in hindsight? Now you look back on it.
I think it could have been predicted up to a point, because I think frankly, I don't think I have high conviction that most of the problem that arose with that war was actually around the COVID-19 virus and cutting of global demand. I'll just give you a little bit of a history and try and put some perspective into this. So basically, the last time we were in a bear market for oil was 2014 to 2017, and in that period, the market was oversupplied by a couple of million barrels a day. So say 2 to 3 million barrels a day in a 100 million barrel per day market. So it was in 2 to 3% oversupply, and that saw the oil price hovering around $50 a barrel. And then in 2017, OPEC, to a large extent, and then together with Russia, decided that they needed a higher price to support their fiscal budget. So it wasn't the economics of oil; it was the economics of the country. And they agreed to tighten up supply just to bring inventories down to their 5-year average, and that was the goal. And that resulted in the oil price getting up above $80 a barrel. So it moved up quite quickly, but the surprise impact of that higher oil price was the rate at which the US shale industry responded, and it got reinvigorated to the extent that from the end of 2017 onwards, the shale industry started growing by about 2 million barrels per day each year. And so basically US shale was growing faster than what global demand was growing by. And that was clearly a problem for the OPEC plus cartel, in that they were having to continue to cut supply to balance the market and support the price, which was then incentivizing the marginal producer to continue to grow. And it became a vicious spiral down. Got to the point that early this year, when demand started to weaken in China because of the COVID-19 virus, Russia and Saudi got together to see whether they could rebalance the market, but they found that they needed to rebalance the market too much. And that would be supportive of US shale, and I don't think they weren't specifically attacking US shale, but they just realized that they couldn't support the market significantly on their own. The real surprise, though, was in my mind, was at the time when they were having those initial discussions, they saw a market oversupply of 10 million barrels per day, so 10%. What we actually believe we're in this current environment is an oversupply of 20 to 30 million barrels per day. So there's been demand destruction in March and April of 20 to 30 million barrels a day, which is just way beyond what OPEC plus, OPEC and Russia could have coped with. So if you put some round numbers on that, the global oil market is 100 million barrels a day. OPEC's about 30 million barrels a day. Russia is just over 10 million barrels a day. And the US is about 13 million barrels a day. But there's a demand destruction of 20 to 30 million barrels per day. So unprecedented is certainly the word. The oil market has never had this amount of surplus, and we're in a situation where there will be nowhere to put that oil. The inventories are finite. It's as a liquid, you can't continue to store oil. And frankly, I think this cut that we saw in the last weekend was very much a reactionary cut, the 10 million barrels a day. It had to be cut because OPEC and Russia have nowhere to put their oil. There's no offtake for that oil, but it's not enough. So and I think the likelihood is that the oil price will continue to struggle until we get through this period of the virus.
And I saw in the news reports that, okay, whilst the agreed cut was 9.7 million barrels per day, and as you mentioned, that's close to 10% of global pre-crisis demand. There was also the additional impact of some of the shale businesses not being able to produce at all at this current level, and that would take it up to that region of 20 to 30 million barrels that you were talking about. Is that the case?
I think it'll be slow, and certainly you will see a significant reduction in drilling activity in the US. But wells that have already been drilled will continue to produce. So the contribution that the US is making to this, and the contribution in inverted commas, is that they will face natural decline. So there will be less drilling and less completion of wells, and so over a period of a year, you may see the US contribution falling by an order of 2 million barrels per day. So it might go this year, well, at the current rate of say 13 million barrels a day. By the end of the year, it might be down to 11 million barrels a day, and then lose another 2 million barrels a day next year. So it's not going to happen that the US on its own is going to balance the difference between current demand and supply. I think there's going to be need to be another leg down from the bigger industry as a whole. So everywhere that's got marginal production is going to have to lose production, and the US shale industry is only going to balance margin or at the margin in an incremental fashion. And I think it's also just worth highlighting that a lot of oil production at the wellhead, and that marginal cost is only about $10 a barrel. So oil price could go down that far before you actually see wells being shut down. It's just the capital cost which takes the incentive price for oil higher, and then it's also the fiscal cost. So countries that rely on oil to balance their budgets, but actual production of oil, that cost is very low, and that's why it has been mentioned often in the press that the oil price could get as low as $10 a barrel if this environment of oversupply persists.
It seems incredible, and I don't think that was factored into many people's assumptions at the beginning of the year. But let's move the conversation on to Sasol now, if you don't mind. What does this situation mean for Sasol and the tighter borrowing requirements, as they alluded to in their interim results?
Yeah, so Sasol is obviously in the eye of the storm here. It doesn't actually produce oil, but all of its product is linked to the oil price. Typically, and the earnings level for Sasol, if I put a round number on it, it's sort of 30 to 40 rand per share that you get at an oil price of about $40 to $50 per barrel. So much of the performance of Sasol share price over history is driven by the oil price and obviously the rand as well. So if we think about it in terms of rand oil price environment, but what Sasol has, in the foundation business of Sasol has suffered from this lower oil price. It's basically got down to its break-even level where there's no earnings coming from the foundation business of Sasol. So the lower oil price in undermining the underlying business, I think, is the biggest driver of the share price fall, say to about 300 or 350 rand per share. But below that level is when one starts to get worried about the level of debt that sits within the company. And that debt has obviously been built up in the construction of their Lake Charles cracker project in the US. So that's an ethane cracker that will have cost them in excess of $12 billion to build. What we've seen a few times over the past 3 or 4 years is how companies, when their commodity price collapses, you would normally expect to see a valuation anchor in the share price. But when there's a high level of debt, that valuation anchor falls away, and you start to get into this debt to market cap spiral down. We saw it with Anglo American and Glencore in 2015 and 2016, and subsequently even in Impala and Sivan, where the underlying equity value got eroded way below the fundamental value. And in Sasol, in this environment, so in March, we saw the share price falling to 0.25 times price to book, which is just not a reasonable level, but it just reflects the quantum of debt relative to market cap. And the company responded, I think, much in the same way as Anglo American responded. It was in a similar situation. They went into, or they announced a cost-cutting exercise of $1 to $2 billion asset sales of $1 to $2 billion. They're looking to push their covenants out, so they think they're okay for their debt covenant at 3.5 times for June this year, but at 3 times in December will be a problem, so they need to push that covenant up. But if they do, then their liquidity is fine, and we noticed also with Anglo American at the time, their liquidity was good, and that's what carried them through. But they've also spoken about the likelihood that they will need to do an equity raise after their June financial year end results, and that will be partly to plug the gap in terms of reducing their debt and relative to the amount of disposals that they can make. So it is it's a broad strategy that they're following, but clearly the issue right now is the combination of the weak oil price and the high debt. As I said, there have been a couple of examples of companies that have gone through that over the last 3 or 4 years.
Obviously, there's still the potential upside in growth in earnings from the Lake Charles project. Is the current environment going to have an impact on the expected demand from that part of the business?
Yes, no, that's right on both fronts. So what we did like about Sasol when we started to get visibility on the cracker coming into the business or into the earnings was that it was a rare growth vector in the resources sector. As I indicated earlier, capex in the resource sector mostly peaked back in 2011. Sasol has been spending the capex to grow a business and it would have added about 25% to its earnings. So it wasn't it is an attractive growth vector. The problem, even from a couple of years ago, is that we were looking at an environment where global demand growth was slowing, and there were several crackers that were coming into production at a similar time. So capacity utilization in the global cracker industry or the global ethylene industry was going to fall. And so there was a risk that Sasol was going to ramp up into a weakening petrochemicals market. And by delaying the cracker, or by the cracker being the project being delayed, it pushed that ramp up into really the weakest point of the petrochemical industry. And that has obviously taken a step down now. So the things that we look at in petrochemicals, and we look at capacity utilization, we look at the cost curve, and typically if you're an ethane producer, or if you use ethane to produce your ethylene versus using naphtha or an oil-based product to produce your ethane, your ethylene, as an ethane producer, you're a lower cost producer, which favors Sasol. And then we look at the multiplier of ethylene consumption to GDP. So it's typically if the world is growing at 3% per annum, then ethylene demand will be growing at 4.5% per annum. That multiplier has really dropped to about 1 times. And it's expected to continue to stay at a lower level. So what we really need to see now for Sasol and the cracker is that capacity utilization bottoms out and global growth recovers. So it doesn't need to go back to the sort of 3.5% level. It just needs to recover from these very low levels and start to consume that excess capacity in the global ethylene industry, and that's going to take some time. I think one would be looking from 2022, 2023 as a point where the cracker can start to deliver towards the targeted $1 billion per annum of EBITDA, and at that level it becomes an attractive driver of the investment case for Sasol.
We could talk for a long time just on one company, but just final comment on Sasol. Are you adding to your position at the current levels?
We haven't been adding at the current levels. Basically, we've taken the view that there's likely to be a capital raise, and that capital raise is likely to be $1 to $2 billion. So at the lows on the share price, that was a multiple of the market cap of the company, and the market cap actually troughed at about 15 billion rand. So what we're doing is we're in a position where we would regard ourselves as just very slightly overweight on Sasol, but we keeping our powder dry to participate in a capital raise, which we think will be an attractive opportunity to increase our position at a discounted price on a discounted valuation. Yes, so that's okay. Very much the approach we're taking.
Okay, thank you. So maybe we can move on to the platinum group metals now, and your views from where we are now. Obviously, palladium more than doubled last year. Rhodium was up 5 times, and platinum was up a significant amount. Although it's currently trading around where it started the beginning of 2019. What's your view on the prices, and do you hold direct exposure to the commodities, or do you go via companies, so the producers of the commodities?
Yeah, okay. A few questions there, but yeah. So basically, and 2019 was an exciting year for the industry after many years of deficits, and particularly in palladium. So we could observe significant market deficits in palladium in the tune of 1 million ounces per annum in what was a 10 million ounce per annum market. So very big deficits that weren't moving the price. And then to a lesser extent, rhodium also had those deficits. But then suddenly what happened in the course of 2019 was that the stock that existed above ground was no longer able to feed those deficits, and that was partly because the deficits had run down, because the stocks had run down, but partly because the world was starting to have to increase their loadings of platinum group metals on the autocatalysts of cars, and that was emission standards increasing, and the one was China. So China has aggressively been ramping up its standards on vehicle emissions, to meet and then to even exceed the standards in Europe and the US. So it always used to lag about 5 years behind the West, and then it caught up and has overtaken them this year. And then also in the West, and following, you may remember the issues around Dieselgate, where cars had been cheating, or companies had been cheating on the emissions. So a different way of measuring the emissions to better replicate real world driving standards came into place, and that also has resulted in an increase in loadings. So we saw the significant price escalation of palladium and rhodium specifically drove massive moves in the share prices, and basically we took the view that those tight markets would sustain themselves for the next 3 to 5 years, and the only thing that could derail that tight market was a global recession that knocked global vehicle volumes by 10 to 20%. And we felt at the beginning of the year that likelihood was relatively low. But what happened, obviously, the virus came and has absolutely smashed global volumes. And the interesting thing is not just demand for cars that has slowed, it's the ability of companies to actually make their cars. So in Germany, they actually shut the Volkswagen factory because they couldn't source the parts from around the world because of the breakdown in the supply chain. And that caused some real shockwaves through the platinum group metals industry for really just for probably a couple of weeks. And we've seen a substantial recovery since then. So at current prices on platinum group metals, and if you add the weak rand into it, the miners are looking very attractively valued. I put two caveats in that. The one is that we don't really know what spot prices mean because there's not much happening in terms of actual underlying demand. We are comfortable that when demand normalizes, those markets will be tight, but we don't really know what a $2,000 an ounce palladium price means today. But under current prices, the miners, if these prices hold, the valuations will be attractive. And then the second factor is operations. Obviously, many of these mines have been quarantined through this virus period, so they're not necessarily benefiting as much as what they should from the higher prices. So we need to see a normalization. But if things normalize in terms of recovery in operations and recovery in vehicle volumes, the platinum sector, I think, still has a good run.
And you mentioned the mining companies there, but you did hold some platinum and rhodium ETFs. Do you still hold those? And is that why would you do that rather than holding the businesses themselves, or when would you do that?
Yeah, yes. So broadly, we look at the value of the equities versus the value of the metal, and if we feel that the equities are expensive, we'll own some metal. We're not a big holder of the metal because it is difficult to value, but we'll make a relative view versus the equities. But we have just taken a view recently that because of the supply disruption, we may find that particularly rhodium and platinum could be a beneficiary of the closure of mines in South Africa, because both of those are sourced about 80% from South Africa. So about 80% of rhodium and platinum comes from South Africa. In palladium, it's only about 35%, so that's less of a play on South African mine disruption. But we actually closed out the position in the rhodium ETF just recently because of its price recovery. But we are just looking to take advantage of disruption on supply.
Okay, thank you very much. And can we just quickly touch on some of the more defensive positions in the portfolio and start with gold? And given where the gold price has got to now at 1730, up about 33% on a one-year basis, how do you assess the pricing of gold at the moment, and then the knock-on effect onto the gold miners within the SA universe?
Yeah, so gold, within the context of us not taking big macro views, and I think at the best of times is a very difficult asset. It's unanchored, so other commodities you can do supply and demand analysis and cost curve analysis. Gold doesn't really perform to those metrics, and very much of the demand of gold comes from investment, which in effect is an inventory build, which is a period where apparent supply is higher than demand, so it doesn't fit into those metrics. But from a bigger picture perspective, there's three broad drivers that are positive for gold. It's periods of geopolitical uncertainty, a macroeconomic risk, so I'd say specifically a stagflationary sort of environment, and then a financial contagion sort of environment, and we're certainly seeing those scenarios in the current world, so we can understand why gold has outperformed, and we still think that the risk situation remains in place to support gold. I think it's worth remembering that the big performance in gold around the global financial crisis was after the GFC. From 2008 to 2011, the gold price went from about $725 an ounce up to about $1,900 an ounce, and we do see a position currently where gold can continue to remain supported both by the risk and uncertainty, but also, and I think even probably more so by the quantity of stimulus that's coming through, and if one is looking to try and sort of put one's hat on what drives the gold price, I think it's more of a contiguous driver, but it would be low global interest rates. So if the US 10-year yield remains at the lows of below 1%, then it's likely to be very supportive for gold because the cost of carry on gold is low. So I don't want to take a punt on what I think the gold price is going to do, but I do think that this current environment remains supportive for gold.
And does that have a direct correlation with the performance of the gold miners?
Yeah, and the gold miners, so gold bullion is very much your uncorrelated asset class, and in a balanced fund. Gold equities, the window of opportunity in gold equities is much narrower. So they tend to be destroyers of value through time, or they have been. So if one analyzes the period up until 2011, the 10 years leading up to 2011, there was a lot of value destruction from rising costs, from falling volumes, from share issuance, poor capital discipline, and then from a derating of the gold sector. So we've been through a lot of periods where you haven't benefited from owning gold equities, whereas you would have benefited from owning gold bullion. And we think that situation is different currently, in that over the last 5 years, all three of those factors have shown much more discipline, and the gold equities are lower rated than what they were through the 2000s. So there are relatively better position now to benefit from the higher gold price. And what we do need to see is operations coming back online. So a stock like Harmony, which we don't currently own in the fund, but their mines, obviously, they're mostly South African deep level mines, and they've been closed down in this quarantine period. So that is something one needs to watch out for. But I do think that the gold miners are relatively attractive here.
Thank you. And the other area of defensiveness is perhaps the diversifies through industrial metals, and Anglo American is the largest holding in the fund by a long way at around 22%. Can you just give us a very quick view on your prospects for Anglos?
Yeah, so I think just perhaps to contextualize the defensiveness position, a lot of the defensiveness comes from low operating gearing and low financial gearing. And Anglo American is one of those companies that has gone through a significant amount of reducing of its financial gearing over the past 3 or 4 years. So the defensiveness comes about because their margins have improved through operational improvements and through the reduction in the balance sheet, and then also through the diversity of its asset portfolio. So it's got commodities in all the different quadrants of the business cycle, and so within that, and the platinum group metals has been a significant driver of the Anglo American performance and our view of the stock. But then iron ore is the other big commodity that has done well. And I think iron ore, in many ways, has surprised us as to how robust it has been. But it is a real oligopolistic commodity where you only really have you have 4 big producers, and Anglo American is actually the 5th of. It's outside of the 4 big producers, but there is good control of supply of iron ore into the market, and most of it, as I indicated earlier, goes into China. And China's offtake has been good through this period of economic weakness, and partly because their own mines have been disrupted, but also, and with perhaps some concern, but because the steel industry has continued to operate at a high level. So they've taken the iron ore and produced steel, but the steel has gone into inventory. So now what we need to see from China is that the steel inventories start to draw down. So I think that and from a seasonal perspective, steel inventories in China build around Chinese New Year, but the steel inventories have now grown about 3 times as high because of the slowdown in the economy there. And what China now needs to do is stimulate infrastructure and property and start to consume that steel. And if it doesn't, then eventually it'll push back into iron ore. But for now, iron ore holds up well. And I think the key point also is that many of the iron ore miners or in Anglo American, even as an example, is relatively low on the cost curve. So even if the iron ore price was to fall by 20%, you would still be making very good margins in many of the iron ore miners.
Okay, thank you. And then I'm conscious of time. We've gone well over, but my last question is on Sibanye. It's a significant position in the fund, and there's recent changes in the middle of last year and culminating in the name change earlier this year. What are your thoughts on the future prospects of that company?
Yeah, so Sibanye, it certainly it went through a difficult period when it took on a lot of debt. And really did overpay for its acquisition of Stillwater in the US, and I think that in many ways is unquestionable that it overpaid. But what they did do with that Stillwater acquisition was they timed it very well, so they got advantage of the real rally in the palladium price, and then they've made subsequent acquisitions, and specifically of Lonmin, which was, I think, a lower quality asset, but again, the timing and the price that they paid for Lonmin was very good. They did leave them in a position early in 2019 where they had too much debt, and so they had very high financial gearing, and they also had very high operating gearing because their margins of their assets were low. But through the period of 2019 and early 2020, with a very strong rise in metal prices, that financial gearing became very much less of a problem. And their margins have improved significantly with the higher rand gold price and with the higher PGM prices. So I don't think it can be regarded as one of the higher quality miners in our universe, but their quality has improved with the higher margin of the Stillwater acquisition. And as I said, the balance sheet is better, and it's looking at current prices to be to have very good valuation opportunities. I think that the one area that one has to be a little bit concerned about Sibanye is that their business model is very much built around acquisitions. In fact, the CEO has gone on record saying that he would like to make a big gold acquisition in North America. So one does have to be cognizant that they have a strategy of growing. I think one can give them credit for having made some good acquisitions to build the business up to this point, but I think it does put something of a dampener on the rating, in that one doesn't. Well, one can't afford to give them full benefit of the doubt that they're going to make good decisions or continue to make good decisions. But the valuation case is now, in my mind, compelling.
And then finally, is now the right time to be buying the resources sector?
Yeah. Okay. So on a normalized basis, I think that it is attractive. If one looks at the EV/EBITDA of global miners versus global equities, is trading well below a standard deviation below the mean for the last 20 years. So the global mining sector valuation metrics are attractive, and I think the market in some ways is partly discounting the growth risk, but it's also discounting the period of the last decade when the miners had poor capital allocation, and I think that capital allocation for the most part has improved. So I think this rating discount is unwarranted, and what it doesn't give credit to the miners for is the supply side constraints that are going to come through over the next 10 years and support commodity prices. So I think the fundamental case for mining equities is attractive now. What I do just caution against is this period of uncertainty and then recovery coming out of this economic slowdown. It's become much more than a health crisis. It's now an economic crisis in many ways. People talk about depression. So I think there could be a period where demand disappoints in the short term, and in my mind that this is the opportunity to be building a position. So I am certainly constructive, but I'm constructive medium term. I'm cautious short term.
Well, thank you very much, Simon. I think everyone would agree that's a comprehensive tour of the resources sector, and I really appreciate your deep level of insight there. So thank you very much for joining us today.
Yeah, it's a pleasure. Thanks for having me.
So thank you as well to everybody who joined today. The call has been recorded should you wish to listen back to the comments today. A reminder that tomorrow we will have Koki Koiman from our partner Denker Capital, the portfolio managers of our Nedgroup Investments Financials funds, and we'll be digging deep into another key component of the SA equity universe. And finally, a call to all of you for recommendations of who you would most like to hear from throughout our stable of third-party managers. We're looking to extend these calls into the future, so please send through any suggestions you may have onto your regular Nedgroup Investments contact. And so from me, thank you very much for joining, and have a good rest of the day. Bye-bye.